Hey everybody, welcome back to the channel. Hope you guys have been doing well. In today's video, we're going to cover a little bit of macro. I'll dive into some TA, let you guys know where I think the market's headed. And on the video with the DeFi project that I think has a lot of potential. It's still in its very early stages. In fact, it hasn't even gone live yet, but I think it has a lot of potential. And personally, I'm actually looking into participating in its private round. So if you wanted to hear more about that project, make sure you watch this video until the very end. And also, I'm planning to take a vacation for 2 weeks in September. So I won't be making videos during that time, but I will try to get out another newsletter. And if you haven't subscribed already, make sure you do. Just click the link in the description below and enter your email address. I recently picked up a co-contributor who's really dialed into the space and did incredibly well during the last cycle. I think the guy has a lot of potential and he could be an absolute killer in the next cycle. His name's Don. You can follow him on Twitter, and he also has his own newsletter that you can subscribe to. I'll make sure to link it in the description below. With that being said, let's go ahead and dive into this video. Alright, let's begin the video by covering some macro. I decided to take the time to watch a few interviews conducted by Fed members. I'm talking about high-profile members that definitely have some influence over the decisions that are made. And the reason I did this was back in February, March, I started watching some of the pressers that Powell did. I did that because rather than listening to all the macro guys out there, all these quote-unquote experts that were forecasting a pivot, I wanted to hear the guy for myself. It became super apparent to me that he definitely wasn't going to be pivoting anytime soon. So I've built the habit of just watching the interviews myself. And out of all the interviews that I watched, I wanted to highlight 2 points. Number one is that the Fed definitely plans to combat inflation by bringing down asset prices. And to do that, they also have to, at a minimum, induce a mild recession. Now, we can definitely debate on their ability to do that. Some think that they're going to overshoot, cause a deep recession, potentially a depression. And others are arguing that the higher probability is that we end up having a short and shallow recession. Regardless of which camp you're on, I think at this point, it's pretty obvious that they definitely want the economy to slow down in order to bring inflation down. They can't say that directly to the public, but you can find clues in some of the answers that they give. For example, Bullard kind of hinted at the fact that they were expecting asset prices to come down as they began to increase rates and remove assets from the balance sheet.
The concern that some members of the committee have had is that, as you said, it's been market pricing. It's not the full effects yet of the tightening. And when that hits, the economy may be weak. And then you're doing a disservice by sending us into recession.
You know, long and variable lags was something uttered by Milton Friedman, but that was based on data from the 50s and 60s. I think today's market, it's partly because of media like this, it moved very quickly in response to projected passive policy. And I would cite as exhibit number one, the housing market, which has already slowed down substantially in the spring here. And it started to do that before we even made much of a move. We would only move 25 or made 1 or 2 moves and hadn't even started the balance sheet runoff. So
notice that towards the end how he said that the housing market started to move down before we started taking action. To me, this implies that they were expecting the housing market to come down quite a bit as they began to tighten. And the reason I think this is worth highlighting is because I remember a few months back, I was telling one of my good buddies that they do want the stock market to come down. They do want housing to come down. And he was adamant that was my interpretation of what Powell was saying, and that's not what they were after. But as you watch more and more of these interviews, it becomes clear that that's exactly what they're trying to do. Now, the second point I wanted to highlight is that the Fed can only address inflation by modulating demand. And one way they can do that is by creating conditions in the economy that cause the labor market to loosen up. Because if you have a tight labor market, that puts pressure on wages. Wages go up, which means there's more money circulating in the economy. And conversely, when the unemployment number goes up, there's fewer jobs, fewer people getting paid, so less money circulating in the economy. And since you have more people competing for the same pool of jobs, it should drive wages down. And since you have fewer people working, in theory, we should also see less money circulating in the economy. So instead of focusing on CPI, I think the more important number to look at is the unemployment number. And in a recent interview, Easter George, the Kansas City Fed president, also highlighted the importance of having a looser labor market.
Does the unemployment rate need to rise to bring down inflation?
So the labor market is very tight, and I suspect to get some loosening in that labor market, you will see higher unemployment. Difficulty finding labor, a tight labor market, wages rising, adding jobs every chance they get. So That dynamic is not clear yet, despite the fact that we had 2 quarters of negative GDP and added 3 million jobs. So it is an unprecedented kind of situation when you think about recession dynamics.
So in summary, I'm very hesitant to deploy capital here because you're basically seeing a massive repricing across all assets as the Fed removes liquidity from the market. Now, if everything else was a constant, maybe I would be deploying capital here, but the challenge is, how do you figure out what the fair value is in an environment where we could potentially have a recession, a deep recession, and there's a lot of geopolitical tension? All these changing and unknown variables make it really hard to figure out what the fair value of these assets are. So in that environment, I would rather just sit tight, let everything play out, and begin dollar cost averaging into the market when I think the time is right. All right, moving along with the macro. Unlike Asian countries, here in the United States, we love using credit. But the problem is, it means that if there's any cracks in the economy, they're going to show with a lag. Michael Burry recently sent out this tweet. He said, net consumer credit balances are rising at record rates as consumers choose violence rather than cut back on spending in the face of inflation. Remember the savings glut problem? No more. COVID helicopter cash taught people to spend again, and it's addictive. Winter is coming. And this complicates things for the Fed because if they're data dependent and consumer spending remains strong because people are using more and more credit, there's a higher probability of them tightening too much for too long. And on top of that, the last 2 times consumer credit growth accelerated alongside collapsing sentiment, we ended up going into a bear market. And I think it's just not the US consumer that's going to be under pressure. If you look at China, their PPI has been declining ahead of ours. And typically, because the economies are interconnected, you'll see their PPI lead down the US PPI. And unlike us, they're not tightening, they're actually easing. And the IMF also released the following data. The world's 3 largest economies, the US, China, and Euro area, are stalling with significant consequences for global outlook. Growth will slow sharply from 6.1% in 2021 to 3.2% in 2022. And to make matters worse, China's Chengdu region to lock down millions over a COVID outbreak. Chengdu is the home of factories run by Toyota Motor, Apple supplier Foxconn, and will affect over 21 million people in the biggest shutdown since Shanghai's residents were confined to their homes for 2 months earlier this year. And like I stated earlier, there's also geopolitical tensions, and they're actually impacting individual companies now. Nvidia said that before they weren't allowed to sell to China anymore, it had booked $400 million in sales this quarter to China that could be lost if the firms decide not to buy alternative Nvidia products. And the reason I'm mentioning the China and global slowdown is that in the United States, we have a lot of global companies, and a good chunk of the revenue, I would say in some cases, 20% plus is sourced from abroad. So if there's a global slowdown, it's definitely going to impact the earnings of American companies. All right, now we're going to transition into some TA. We're going to keep it short, simple, and to the point. Now, if you've watched my past videos, you know I like to use the following indicators to get a sense of which way the market's going. I think altogether they do a pretty good job of providing confluence. The first indicator that we're going to look at is JNK, the high yield bond ETF. I don't see a lot of people using this, but I think it's pretty good at approximating when we're going to get bounces in the market. I drew this blue line before we started consolidating here. And as we started consolidating, I told my private members that I think we're going to go ahead and begin a brief risk on period. That's exactly what followed soon afterwards. And now, after hitting resistance here, we might be on the market's next major leg down. And I don't just use JNK alone. Remember, I'm using all of these indicators together to get some confluence. Now, if you look at the VIX, it bounced off a previous support level, and it looks like it could potentially be going a lot higher from here. I mean, if you take a look at the weekly candle, anytime that candle has closed green, we basically see it followed up with the big move up. We saw that happen here, we saw that happen here, and we saw that happen right over here. And if you look at the treasury yields, all of them have been climbing up, which suggests that the market is favoring a risk-off period. And lastly, if you look at the dollar index, to me it looks like it's ready to keep going higher. Let's take a look at the monthly here. The next key area is this here at 120. We'll probably see some resistance here, but between 110 and 120, there's just air. I mean, if this was an altcoin chart, you'd probably be longing it because look, it failed to break resistance here, failed to break it here, but cut it like butter on the third try. And ultimately where it tops, nobody knows. But if you take a look at the 70s, when the Fed was combating inflation, we hit a high of 163. I'm not suggesting that's the high for the cycle, but I think people who are suggesting that we've hit the top and we're only going to go lower from here are probably going to end up being wrong. I think at a minimum, we're likely to hit this 120 level here. And any time when we've seen the dollar index rally, crypto has taken a hit. I mean, if you take a look at when we had the last bull run in 2017, the dollar index started to go down in 2016. It hit a local bottom here in February 18th. And if you recall, the market topped off in December, January-ish. From there, it rallied up. And after we hit this local top, we began our bull run of 2020, 2021. And then when we hit this local bottom here and we started to consolidate a bit, this is when the crypto market had a major correction. So I think as long as this index continues to rise, the probability is that crypto is going to keep going further down. And if we take a look at Bitcoin using the 50-day moving average in red and the 200-day moving average in blue, you can see the trend at the moment is clearly favoring more downside. I mean, if you look at the 200-day moving average, when we crossed that to the downside back in 2018, we had a year-long bear market after that. But as long as we stayed above it, we remained in a bull market. In 2019, when it went above the 200-day moving average, we basically started the bull run. We had an accumulation phase here. And I would argue that this big move here was a deviation. If it wasn't for Corona, I think we would have stayed around this level before going a lot higher. But clearly after moving above the 200-day moving average, we started the next bull run. And then here in June, we saw it go below it. And in my opinion, I think this big move here was just a huge deviation. It shouldn't have happened. It got extended far longer than it should have. We had people basically borrowing money from others, taking on additional leverage. We had exchanges engaging in heavy marketing here. So in my view, this shouldn't have gone up as high as it did. I think we probably should have ended the rally somewhere around 40 to 50K. But anyhow, now we're clearly below the 200-day moving average again, and we're not anywhere close to going above it, at least for now. And if you look at the 50-day moving average in the red, every time we've gone below it, we've seen a major leg down. And if you look at the chart now, it briefly went above it, and we're again below it again. So just by looking at these two indicators alone, clearly the market is favoring more downside. And on top of that, if you look at the Fed liquidity indicator, it continues to trend down. Anytime you see some sort of acute rise, the market goes risk on. But as soon as you see the liquidity indicator go down, the market goes down right with it. And I think partly that's what drove this big move up here. You can see that the Fed continued to engage in QE months after the May top. And in September, they're going to remove even more assets off their balance sheet. So I'm expecting that this indicator will continue to trend down. And if that ends up playing out again, that's more confluence for additional downside. All right, in this last section, we're going to cover a project that I think has a lot of potential called Berachain. Berachain is going to be a EVM compatible smart contract chain built on Cosmos with cross-chain capability. The devs are anons, but they're very engaged with the community. They've done at least one interview that I know about on market capping. And from what I understand, they have a large pool of talent to choose from. I understand that they're able to source developers from major tech companies. Now, this layer 1 that they're building, it's going to allow users to deposit various L1 tokens, stablecoins, blue chip DeFi tokens, and earn shares representing their deposits. These deposits are going to be moved into strategy vaults that are utilized to provide liquidity to DEXs, lending markets, and to help the peg of honey. And as a result, they refer to their chain as a proof of liquidity consensus. In other words, they're basically going to try to enhance the overall liquidity in the market, make it more efficient, and hopefully making it sticky enough so that it becomes a bedrock to collateralize their own stablecoin called Honey. They're going to have 3 tokens, Bera, which is the gas token, BGT is the governance token, it's going to be non-transferable, and lastly, they're going to have Honey, which is a collateralized stablecoin. And the way it works is that a user can provide ETH or other tokens to earn Bera tokens. Users can stake the Bera token to get BGT, which is the governance token. By owning BTT, you'll earn fees paid out in honey that are generated from the various strategies that they've deployed. And part of the reason they wanted to be an L1 is so that dApps could be built on top of their protocol. For example, they want devs to build DeFi protocols, GameFi projects, and NFT dApps within the ecosystem. There is an NFT marketplace coming. In fact, they have their own rebasing NFTs. If you guys wanted to get exposure to them, they've been vague about the benefits, but there's speculation that they're going to be drop tokens. So if you guys wanted to get some exposure to Beara early, you can head over to OpenSea and buy one of their Beara NFTs. And to get a link, make sure you guys check out their Discord. They got links to all of their NFTs. In terms of fundraising, they got money a few months back. They're planning to do another private round before going public. So it does seem like cash isn't a problem for them. They should be able to endure through the bear market and build a product. Now, they don't have a fixed launch date, but they could potentially have testnet within this quarter. And if you participate, you're very likely to also receive some benefits from that. Mainnet probably won't launch until next year. They want to make sure that they get the launch right on the first go. So they're doing heavy testing and auditing before they go live. And currently there is no white paper. If you go on their site, it's not fully developed. But in one of their interviews, they did mention that it was something that they were working on. So you could potentially see it being released in the next few months. All right, folks, that's pretty much the end of the video. If you enjoyed today's content and you wanted to be part of an alpha community where we share these types of opportunities very early with the community members, definitely check out my Discord by clicking the link in the description below. It's not as active as it used to be because of the bear market. And typically what you end up seeing is that the people who make it in the bull run are the ones that are heavily researching during the bear market. So if you wanted to be one of those folks, definitely check out the Discord channel. With that being said, this is CryptoOneStop signing out. I'll talk to you folks next time. Bye.